Welcome, everybody. This is Exit Engine's Exit 101 for SaaS founders. My name is Joe Stapleton. I'm the co-founder of Exit Engine and a founding partner and CEO at Exio Advisors. With me today, as always, is my friend and partner, Mr. John Caniffe. Hello, John.
Joe, how are you today?
I'm doing great. So if you're here and you're probably have been thinking about selling your SaaS business, and whether that's now or in the future. So here's the truth, and we're going to get right to it. Most SaaS founders are leaving money on the table because they don't prepare for their exit the right way. Right, John?
Exactly correct, Joe.
So what we're going to try to do today is point out the difference between an okay exit and a life-changing one is going to come down to strategy and how early you start preparing for your exit. Valuations, buyer expectations, deal structures are evolving fast. They're changing all the time. And if you don't know what drives premium multiples or what kills deals, you could be in for a rude awakening now when it's time to sell. So John and I have worked with many SaaS founders, both in this business and earlier in our careers. And we have seen firsthand how this preparation, the right preparation, could literally add millions of dollars to your exit. The wrong approach, on the other hand, can lead to deals falling apart, selling far less than expected, and otherwise contributing to a kind of negative exit. And what we're looking for today is to take you through some key factors that will make or break your SaaS exit, how to avoid those costly mistakes, and the steps you can take right now to position your company for the highest possible valuation. Now, this is true, guys, whether you are planning to sell in 6 months or 6 years. But what you do today, starting today, could very well determine your future payday. Right, John?
Exactly correct, yeah.
So without further ado, a little bit about us. My name is Joe Stapleton. Again, 32 years of business management experience. I've done a lot of work in the technical space, strategy, marketing, and operations. I have exited 4 companies myself. I have $400 million in value creation we've calculated over the years. And of course, I'm also with John, a co-host of the Exit Engine podcast.
And I'm John Caniffe, 30 years of business experience, primarily in finance strategy, operations, and technology. I participated in one company that we sold back in early 2000s. I've led a corporate acquisition team at a large entity buying companies, and I am as well the co-host of the Exit Engine podcast.
So without further ado, guys, we want to get into this right away. We got a lot to cover today, so hope you're taking notes. By the way, just to let you know, if you would like to have this presentation emailed to you at the end, you are welcome to actually put your email address right into the chat today. We will leave some time for questions at the end. So if you want to write some things down, then you can do that and put them in. We'll leave some time for questions, certainly at the end. Okay. So let's talk quickly about what everybody is going to be on everybody's mind first, right, John? Which is the valuation. This is the thing that basically almost everybody thinks about first. So what are the ways in which what do we need to know right now about what's driving SaaS valuations?
Yeah, I mean, there's a couple of different ways that companies, depending on the company that's buying you, the type of company that's buying you, there's all sorts of ways to value a SaaS company. Some are looking at annual recurring revenue. Some are looking at traditional measures of EBITDA. And smaller companies are viewed and valued by the seller's discretionary earnings. And there's benchmarks and differences between in verticals, right? There's depending on how big you are, and we'll get to this later, but there's benchmarks and there's things in certain verticals that are very valuable, and oftentimes those valuations are driven by what has happened in the market recently, right? So what if there's been a deal that's recently happened at 12 times ARR or 12 times EBITDA, oftentimes that colors the next valuation or gives an owner a sort of outsized potential valuation that they can get caught up in the numbers and don't really realize what's realistic for their business and how different their business may be on a size basis or an industry basis or a vertical basis from the headline number that they saw in the Wall Street Journal last week.
Great point. Look, guys, the first thing to understand about this is that everybody thinks, wants their company obviously to be valued as much as possible. what we see all the time is that we are, that clients will look at someone else's recent valuation and determine that based on solely that their company is worth more or less, mostly more in most of cases, at least they think that. And what we're really seeing is that we have to understand that there's so much activity in this SaaS market right now that benchmarking and real world deal comps are actually probably going to be a much greater a piece of how these companies are going to want to value you. But the important thing to know is that not all SaaS companies are alike. And so understanding that the vertical market that you play in, understanding the size of your company, and understanding some of these important things of inside your company and your saleability are all going to make a major difference, right? So let's talk about a little bit about how these valuation methods occur, John, and what are some of the common methods that we're seeing right now in SaaS valuations.
Yeah, and this chart's really helpful because it breaks down typically, and again, this is typical, but where annual recurring revenue is used, you see that primarily it's used by strategic buyers and VC investors. And what they're doing is they're applying a multiple to that annual recurring revenue. So they're saying that based on your $1 million recurring revenue, you could go between 3 and 12 times ARR, that revenue. So again, these are for high growth companies, strong recurring revenue and low churn, right? So these companies they're not churning their customers. They probably in most cases, they have their product well defined and they have a group of customers that's staying with them for the long term. Alternatively, you can look at an EBITDA multiple, and what they're doing is they're getting to the EBITDA, which again is earnings before interest, taxes, depreciation, and amortization, and they're applying a multiple of that EBITDA. Typically, private equity firms and financial buyers use this. Again, these are, you see that range, right? It's 6 times, between 6 and 15 times EBITDA. They're mainly for profitable companies, mature SaaS, strong cash flow, and like a slightly higher churn, but not a lot of churn, certainly. And then the smaller firms they typically use seller's discretionary earnings, which again, the way you calculate seller's discretionary earnings is you can think of it as EBITDA less the owner's salary and whatever other compensation, or in quotes, things of value that are paid to the owner. And you can think of this as a company car or any sort of personal expenses that are going to business. Again, all this is legal, but they're going to calculate that seller discretionary earnings to get a true picture of what the company is going forward. And then these are typically at a slightly lower multiple. These might have higher churn. Maybe they're less mature businesses, but the owners are realizing probably about 2 to 5 times. And again, these are averages, but they're getting slightly less as a multiple of this particular valuation.
Yeah, it's really important to understand that the money that you've been paying yourself out of your company, right? The decision to be able to manage your businesses to taxes as opposed to selling, right? The reality is that in a lot of cases, because of the nature of SaaS stuff, where it is a lot of monthly recurring revenue, generally in subscription models and things like that, you can have relatively high revenue. So the revenue is important, and that's great. Obviously, the great thing about SaaS, as we all know, is that you're making it one time and you're selling it multiple times after that, right? And in an exponential way. But I think that the important thing to know is that understand that whether it's EBITDA or SDE, okay, that the reality is that any of that money that you've been taking out of the company for you, if you are no longer part of the company moving forward, then that money that you've been paying yourself needs to go back in, right, go back into the coffers of the company, and therefore immediately raising your multiple. So immediately raising your value because you're taking that $100,000 or so or whatever it is you've been paying yourself, right, at whatever that X multiple is, and that's actually contributing directly to your value.
Exactly correct. Yep.
So important to kind of know that stuff, guys. In general, managing the taxes is the way that most people are running their businesses, no matter what business it is. Now it's a different, we need to change our mindset to be able to get into a kind of a different state of when we're going to sell our company now. It's no longer about the taxes on a regular basis. It's about being able to actually figure out how much money I can actually have in here to be able to be multiplied by the multiple. So top value drivers for salability. So understand that, again, just because you have a SaaS company does not mean it is valuable. It does not mean it will sell. So here are some things that we know that buyers are looking for right now that will actually help you if you understand them. Well, are things that you can actually move the needle on to help increase the chances that you're able to sell.
Yeah,
so the revenue.
Revenue is obviously important. We've talked about ARR. We've talked about monthly recurring revenue as well. The thing that is super important, especially if your universe of potential customers is narrow, which sometimes happens with SaaS customers. If your churn is high, those people who have signed up for their product and left, that can really affect the revenue, right? If your churn is high and you're constantly getting new customers and customers are bouncing, that will definitely affect the multiple that you're getting from any buyer, whether it's EBITDA, ARR, or seller's discretionary earnings.
And by the way, even if your revenue is high, okay, so understand that what buyers are really looking for, right, is they want it to be as predictable as possible. And so when you have a high churn rate and you see that, yes, I get a lot of customers and they stay for 2 months and then they leave, and maybe you're really good at getting new customers in the door, the problem is going to be, obviously, that churn rate is going to be a major factor in whether or not a buyer thinks you're actually sellable. Right.
Yeah. And that goes, again, Joe covered customer concentration and retention, right? That churn kills deals because, again, it's customers that very likely won't come back once they've left. And 2 and 4 go together as well: scalability, operational efficiency, and tech stack considerations. Those 2 things go together because, to the extent that your SaaS is scalable, right, that you won't need to invest too much more money to add 50 to 100 customers. Sure, you'll need some customer service people, but if your tech stack is scalable and your IP consideration, you've considered how scalable is if you're using Amazon or whatever tool you're using, you need to make sure that you can defend those decisions, those tech stack decisions, when companies poke under the hood, because they will get there. They're not going to be able to tell that probably from an initial demo. Hopefully they won't, but when they get in there and they see how much, what your code quality is, they will have people looking at it, especially if you're a SaaS company, or, you will have people poking into your code when you're selling your SaaS company.
Yeah, no question about it. And the reality is too, is that, from a profitability, so scalability obviously is important, right? And so your ability to be able to make the case to a potential buyer about how scalable your business is, where it can go, the directions it can take, et cetera, et cetera. Now, if you've got a multiple product SaaS company, okay, where you have multiple products, also a good thing, right? Being able to not only scale but create a breadth of product is also obviously something that's going to help you. Keep in mind, guys, that what we see out there on places like acquisition.com and places like that on these aggregator sites, you're going to see, and we see all the time, and buyers are constantly looking at these places, SaaS companies that are trying to sell their companies for $30,000 or $40,000, right? They aren't selling companies. What they're selling is software. What they are selling is a product that they know that they have built. They have this thing. They don't want to take it anywhere. They don't want to grow it. They don't want to scale it. And so they're trying to basically kind of like just sell the core software to someone who can then take it. That's not what we're talking about here. All right. What we are talking about here are companies, right, where you have, potentially have staff, where you have product, where you've got a tech stack, right, where you have to worry about things like customer retention, and that the profitability and your ability to expand your margins as you go over time is a good thing. Trying to build a SaaS company that you can immediately sell within 3 months is not going to get you what you think it's going to get you. What buyers want always are predictable, scalable, and efficient businesses, all right, that they can take and grow in the case of something like a private equity firm, or in the case of a strategic buyer, something they can actually add in and will be complementary to the rest of their original product offering, right? So guys, keep in mind that what we're talking about here today is to be able to build a company, not just build a product. Okay. And it's a very, very important distinction to make. So here are some of the things that can go very, very horribly wrong. And these are the kinds of things that we see happen that will kill a deal very, very quickly. All right.
Yeah,
so let's talk about what some of those things are.
Yeah. And these, obviously we're not going to read all of these, but all of these things are not just unique to SaaS companies. There's some that are unique to SaaS companies, but poor documentation in finances, that will kill any deal, right? That's the second one. The one that's crazy, and I mentioned it earlier, is misaligned valuation expectations. If sometimes you have an anchor in your mind, an anchor price for what you think your company is worth, and you've gone through and you get these. If you have that, if you're not willing to move off of that price, that can be a huge deal killer. We've talked about customer churn, and we didn't really talk about revenue concentration, but revenue concentration is a big one too. If even if you're 60% of your business comes from one company, or you've got all your users, and depending on how you look at that revenue concentration by user or by company, it can be a deal killer if it's too much in one company. The one that's often overlooked is too much technical debt. If you have been deferring your capital investment in your product, or deferring routine maintenance, that's a real big red flag, because that can make your profitability look actually much better than it is. So again, if you're taking money that you should go into improving your product and pointing out flaws, or not pointing out flaws, changing those flaws that users have pointed out, that's a big problem. And this often won't be covered until later in the deal. So you don't, if you have technical debt, take care of it. Don't let it build and cause problems in a deal, because again, it'll come out, it'll be determined late, even though you knew about it a long time ago.
And if just to add on to that, if you are in that situation where you've got a lot of that debt, being able to actually see how you can take care of that debt before you bring a buyer in is obviously the best way to go. But the second thing to do is just to understand that it's not necessarily that the debt itself will necessarily be a killer if you are bringing the debt and you are open about what the debt is and why it's there. Okay, so understand that in some cases, you depending on exactly what the deal structure will be, this isn't necessarily something that ends up being an absolute killer, but it will definitely reduce potentially reduce the money that you're going to be able to get from the sale, right?
Yeah, because they're going to have to fix. Yeah, they're going to have to fix that.
That's exactly right. And of course, they're going to look at that, and they're going to remember that buyers in general, okay, are coming in here, and what they're going to try to do, like any buyer at any time, they want to try to buy low and then be able to sell high at some other point. Okay.
Correct.
And so understand that if you've got what they're looking, they are going to try and look at every single thing they can to do to reduce. Their job is to reduce your valuation. Your job is to increase your valuation, right? And so understanding what they're looking for is going to be a key piece in being able to understand how to actually work around the things that are negative and just kind of spin them into positives if you can. So the other thing that happens here, obviously, we're talking about messy books. The other thing is to understand is that your IP, your ownership and contracts, we see so many times, John, right, about how many people have contract things. They don't have IP locked down. And the reality is that if you don't do that in a situation, you are really, really exposing yourself. It's a giant risk.
Yeah, it's a huge risk that will come up later in the process, which is a problem if you don't address it. So, and we already talked about scalability, so we can sort of move along from that.
So again, what is the key here? The key is to start exit planning early, right? The idea is that to not wait until the day you want to sell to try to start thinking about this stuff, right? You need to be able to examine your business, be able to plan early, taking yourself, if you need to, through the actual due diligence process. Try to identify what those red flags might be, start to address those things before, obviously you go to market, right?
Yep.
So let's talk a little bit about what the process is in terms of the selling process. We call this the M&A process, but the reality is it's really about you being acquired. and what to expect. So let's talk a little bit, John, about the types of buyers that are out there and kind of how the structures usually work.
Yeah, and again, these are typical. These are some ways that do it. There's obviously overlap here, but strategic acquirers are often using cash. They're buying the company for cash, maybe a combination of cash and earnouts, right? So they're buying the whole company, or they want you there for some period of time to help them, or to make a particular product go. If you're very tied to one product in your multi-product company, they might want you to stick around. Private equity firms, oftentimes, if they're not bringing their management, they're expecting you to run the company. They want to tie you to an earnout. They want to tie you to a particular revenue threshold, or a particular EBITDA threshold, or churn rates, and they'll tie the second and third and fourth year payments to you to those metrics, to say, if you maintain this revenue, you will get a payout of X, or if you maintain these customers, you will get Y. And again, that happens. Aggregators and roll-ups oftentimes use equity, because what they're doing is, in these roll-up strategies from our previous podcast, our Australian friend Craig, they want to get multiple bites at the apple, right? You might be a part of a roll-up of a dental practice that he covered, that you get one payment from the initial transaction, and then you get subsequent payments each time the company is sold. Now, you're going to own a smaller piece of equity for each time it gets sold, but sometimes a small piece of a bigger pie can be a larger payout than a large piece of a small pie. Did I do that right?
Exactly.
Yeah, I think I did that right.
Yeah. We're seeing what we see a lot, okay, going on right now, especially in the SaaS market, okay, is this aggregator situation, okay, where they are basically where they are conglomerates that basically have started out owning nothing, okay, and literally gone in and and gotten some capital, put together a fund essentially to go out to be the actual operators, okay, to acquire individual SaaS companies or SaaS products, to be able to put them into a portfolio essentially within a company where they've got shared services, okay, so that they can have the sales team, they can have the accounting and all the back office stuff and all that stuff all kind of lined up, shared across all these individual little product SaaS product companies, and then be able to basically put those together, grow that revenue together as a conglomerate, right, and then be able to cash out 5, 6, 7 years from now, and those are the places that are actually end up being the best for our founders, because it's not just a one-time cash thing. It's not just an earnout situation. It's really kind of a combination of all three, where at the end, as John just mentioned, you're left with, yes, I've sold this company, but now I am on the board potentially of this other roll-up company where I have equity in that. And then one day that company gets rolled up to another company, and I'm looking at multiple bites of the apple.
Yeah, and also you get employment, right? A lot of times they offer you employment over the course of that period of time, which again, for certain entrepreneurs and certain people, that can be after they've sold their business. Sometimes you want to stay on for a couple of years. You don't want to start your next venture right away. Again, it depends on your personality, but oftentimes those types of roll-up strategies are right in the wheelhouse of what people want.
That's it. And understand that in those situations, you're probably also going to be on salary, right? So you're talking about being able to make, maybe a few $100,000 a year as well, on top of the earnout, on top of the stock and equity and all that stuff. So these exits can be very lucrative. All right. And what we're trying to get across to you today, and I think the most important takeaway from today is going to be that it doesn't come just because you have a SaaS product. Okay. It's a very important thing to understand. It's going to take a little bit of work and a little bit of insight and a little bit of self-reflection, frankly, in order to be able to make sure that you can actually maximize the value of this thing. Understand that one of the things that we also see is that about 60% of founders overall say that they were either very or somewhat disappointed actually in the result of their exit deal. Okay. Why? Because many times they don't know what it is that they can ask for. They don't even know, basically what it is. They are accepting what a buyer is offering, and then they exit. The integration is bad. Oftentimes there are things that happen, obviously not just about the money, but sometimes about what happens after the deal is done and the way that the integration goes and things like that.
Yeah, and also just a point on that is when we found that when we talk to these people and they're not happy with what happened, they didn't have a clear goal of what they wanted. So how can you be happy if you didn't have a clear goal of what you wanted, right? So if you don't know what you want, you're very likely going to be disappointed by what you get.
That's it. And it's not just about money, right? It's also about maybe what happens to the employees or your employees. It could be about what, again, what happens, with the business overall and the direction it takes.
Correct.
So let's talk a little bit about timeline, because this is now the other thing besides the valuation question, right? This is the other thing that people are often misconstrue and find and often get a rude awakening when they start to actually enter this process. Okay. Your timeline, okay, is not fast. Okay. It is rarely going to be quick. All right. Unless you happen to have everything we mentioned today so far, everything is buttoned up and everything is just great and is a tight little bow with a nice little thing on it, right? It's going to be very, very hard to actually exit your company in anything less than really about 9 months. Okay. We say 6 to 20, we're talking about preparing here anywhere between six months, from at least 6 months to up to about 2 years of just preparation in being able to make this exit. Okay.
Yeah. Because did you want to go? Do you want?
No. Yeah.
Yeah. Because some of these things, if you look at these things, we're not going to read all of them. You guys can see them all, but some of these things are not, things you can do overnight, right? The churn, the diversifying revenue, right? Those are only 2 words on this slide, but that's probably the most difficult thing that you're going to do. And that's why we have 24 months on the slide. People are going to say 24 months. That's so long. That's 2 years, John. That's 2 years, Joe. Yeah. When you have 40% of your revenue concentrated in one client, that's going to take a long time. You have to talk to your salespeople. You have to incentivize your salespeople. You have to go out and sell the product to people to diversify the revenue. That takes a long time. Reducing churn is another thing that takes time that will happen when you improve your product. But if you're not improving your product, it becomes very difficult to reduce churn because people are just leaving because, maybe you don't know why they're leaving. Obviously financials and having for SaaS companies, obviously having the costs attributed correctly to each product. If you're a multiple product company is super important. Because that kills deals when, as an example, we had a situation once where a product looked so much more profitable than it was, and the other products looked very unprofitable. It sort of set off a red flag in my head. Like, you got to clean up those financials to make sure that the costs are attributed properly. And then obviously exit planning and and valuation planning. What do you want? And are those wants realistic given your financial situation?
And again, back to the timeline question, sometimes the things that you want aren't realistic now, but could be, right? If you put the work behind being able to move it there. So it becomes a strategic kind of stake in the ground to be able to say, okay, I'm here now. Can I get here? And how long will that take me to do? All right. So again, what we recommend is that we've got an assessment that you can take. You can go to assessment.myexitengine.com, which is a great place to start. It's completely free. You can take a look. You can have a call with us to see exactly about what exactly is going on inside, kind of under the hood, and start to get a little bit of an idea about where you're headed from a value and saleability standpoint. So we recommend that you do that somehow with someone, and start to be able to look right away in this first phase of where am I right now? All right, and be honest with yourself. Look under the rocks. Right? Pick up the carpet and make sure that you haven't just swept dirt under there, but that you can actually clean this stuff up right now, well in advance of being able to get in front of a potential buyer or some kind of due diligence.
Exactly. Yep. Exactly correct.
So the second phase, okay, that we call that's the go to market and buyer outreach. So now what you've done is that you've spent, maybe the better part of 6-9 months cleaning your books, making sure that your customer concentration is good, making sure that all the kind of the workings and the operations of the company are good. So now we're in a good place from a value. We think we're in a good place from a value and salability standpoint. Now it's time to get that company out there onto the market. Okay. And it's not as simple as taking your company and listing it on acquisition.com. Okay. Or on LoopNet or on these other aggregator sites. Okay. It takes, in order to maximize the value, it takes some specific go-to-market strategy and some buyer outreach, and it's going to take a little bit of time, right, John?
Yeah, it's going to take time, and it's going to take time to properly, position the company for sale in a written form, right? So when you're doing your financials and you're looking at your financials from the perspective of like running your business, it's very different than positioning your company for selling your business, right? Your income statement, balance sheet, cash flow statements, very standard way to look at your business on an ongoing basis. But again, we talked about ARR, we talked about EBITDA, we talked about seller discretionary earnings. Those numbers will appear nowhere. Said differently, those numbers do not appear anywhere on any of those statements. Those are calculations you need to make that are important part of the confidential information memorandum, so buyers understand what they're buying and what the position of the company, not just the way that your accountant's positions the financials. It's how you are positioning your company for sale. Now
if you've got that and you've developed your SIM, what we call the SIM, which is the confidential information memorandum, this is the information. This is your story. Okay. This is the company. This is the company as we developed it. This is why we developed it this way. This is what it does. This is the owner. This is who the owner is. This is the background of the owner. These are the things that all kind of matter, because these are the kinds of the grist, if you will, that goes into the mill of the buying company that says, okay, is this a good bet for me? Right? Is this what kind of risk is this? Does this person know what they're doing? Have they cleaned this company up and they understand that in terms of, do they understand their market? Do they understand, from a technology standpoint, what their market wants? The targeting of the buyers now becomes a kind of an outreach. It's an outbound situation where you're trying to actually go out to buyers, and oftentimes you'll need help doing this. And this is why we brought up the acquisition.coms and these kind of aggregator sites, which are not bad. There's nothing wrong with them, to be clear. It is about, though, how you approach what is the listing on there. Yeah, I think the real estate industry is a really good way to look at it. I think everybody's familiar with the house listing on a website, on Zillow.com, right? Being able to talk about and talk up the benefits of that, what school system it's in, and it's been that the roof was redone and things like that. You want to be able to make sure that you're talking about the good stuff. You're upplaying the positive points, and you're kind of downplaying the negative points, and that you're able to identify who these buyers may be, and that you're going out to as many buyers as you can to find some.
And the different, to take that analogy further, it's like when you're doing the target buyer list, you're reaching out to people maybe that are in your CRM system that have expressed interest in buying at a house like this one. When you're looking at the screening qualified buyers, you're getting at people that are coming over the transom, right? You're getting at people that have seen the Zillow listing and are just coming over. You have no idea whether they're qualified, whether they have financial backing, whether they have any of those strategic fit for the business. And you need to make sure that you're identifying buyers on the way out when you're outbound reaching out to them, but also that you're qualifying buyers so that you're using your time appropriately because again, you're going to be getting all these looky-loos, you're getting all these people that say, oh, I want to see this house, or I want to look at this business. But there's no point in you sending a SIM to somebody who doesn't have any money, who is they call them search buyers, and they call them, they don't have any money behind them. You want people with money who can actually buy the company.
That's exactly right. And of course, you're going to be scheduling a lot of meetings, as John mentioned. You're going to, the reality is that this becomes kind of a full-time job. All right. And so the thing that we recommend the most is that you can actually internally build a an internal, a combination internal and external kind of exit task force. Okay. These are people that are on your staff. There might be one or two people internally, depending on how big your staff is. It might be completely outside. It might be M&A advisors like Exio. It might be some kind of business broker, or it might be some, an M&A lawyer, or people like that. But you're going to need those people. You're going to need a third party CPA for sure. You're going to need a lot of people to be able to help you put this together. And if you are in a situation where you need to be able to increase your value, in a certain period of time, you may need to go out and get a different marketing agency. You may need to go out and get someone who's going to help you drive more revenue. You may be able to have to go out and get and do a study on your customer concentration to see where you're profitable and where you're not. Things like that. So building that task force and of experts that you can rely on, who are on your side, who can help you take this through its process, help you reach buyers, help you do all the meetings, help you screen people, is going to be another thing that's going to help you get through this, get through this process more smoothly. So that brings us to phase 3, okay, which is where we get to letters of intent and negotiation. This might be the shortest piece of the entire process, but it is nonetheless obviously an important, really important piece.
Yeah, because what you might be, and you might only get one letter of intent, right? You might only be negotiating with one buyer. Ideally, you have a couple, but oftentimes you're dealing with one letter of intent. And there's multiple components of, there's cash, there's equity, there's earnouts, and it's aligning what the buyer wants to give you versus what you have set forth in your objectives, and
That's right.
seeing where you stand with that, right? What are you willing to negotiate on, one? And then two, what are you willing to accept from a purchase price and equity and due diligence? And what we try to tell people is, yes, the purchase price is important, but oftentimes, and we were talking to someone recently that the purchase price is one thing and that they're happy with it, but they want a spot in the new company, as an example. So they want to run the product that they're selling, or run one of the products that they're selling to the new company. And it was really important to them to have a job in the future state. Well, if that's one of the most important things, make sure that it's on there. Make sure that you negotiate that point and get that into the deal.
And again, once you then have done all that, you're going to sign the letter of intent that you are which is basically your acceptance of moving the deal forward into due diligence, right? But remember, and we're going to talk about that next, but remember this: the successful exit begins with understanding what it is that you want as an end result. All right. And that includes, guys, and I can't highlight this enough, what you expect out of the integration. Okay. So understand that if it's another company that's buying, your strategic buyer, that's really, really key, is to understand who that strategic buyer really is. Why is it that they think that your company is something that they want to integrate with theirs? Do you like them personally? Because again, you're probably going to be in an earnout situation and probably have to work with these people on a daily basis for the next 2 or 3 years. You want to make sure that you are highly aligned with what you want, with your goals and objectives for moving forward. But more importantly, you want to make sure that there is an actual, we're going to talk about this next, an actual written down in the agreement. The sale agreement is going to be what's going to happen in the integration standpoint. All right. So when we get through due diligence in this phase 4, which again can take, anywhere between generally 6-12 weeks. If there are issues, it could take longer, right? And what the issues are things like, do you have this document? Do I have to go create it? We see all the time sellers start to during due diligence, start to drag their feet. And often it's because they do have actually something to hide that hasn't been disclosed yet. And they're concerned about that. And then other times they start to kind of get a distaste for however the transaction is going with the buyer. Okay. And understand that that's because if you haven't decided, do I like this guy when you first start talking with them, right? And spend that time with them to understand what their strategic objectives are. And does it fit into what your vision for your company moving forward is, or for you moving forward is? right?
Yeah.
So let's talk a little bit about the financial end of things. Yeah.
Yeah. And again, you're diving into contracts, you're diving into revenue, the customer base, you're finding out about churn, about, how well people are signed up, are people leaving, is the churn unnecessarily high because people didn't get retention, didn't get, contracts at the appropriate time. Oftentimes during due diligence, they're interviewing people. Sometimes the level of technical adeptness at a buyer is different than the level of technical adeptness at a seller. Sometimes that's reversed, right? You can have people who are very highly skilled at the buyer and people who sort of fly by night at the seller, and those two things clash, and that's not a good thing. And oftentimes, if there's a very adept seller, they're able to, can hide some things, and that you never want to hide some things in the deal, because it's eventually going to come out, and it will just kill your reputation, as well as leave you liable for challenges. So you don't want to hide things in due diligence. Let me tell you. Yeah.
And the reality is that most deals, more than half. Okay. So once you've signed an LOI and you are now in due diligence, this is really where the rubber meets the road about whether or not this is going to be successful at all. More than half of all deals fall apart during due diligence, right? And so making sure that you have all the documentation, that you know what's going to be asked for, and that you provide that stuff from the very beginning is going to make this process go a lot smoother and give you a much better chance for eventual success. So the fifth phase, okay, is, again, this could take 2 to 6 weeks in general, but the reality is, in an earnout situation, you're talking about potentially adding years to this. Okay. So let's talk a little bit about what happens in the transition and what does that look like. So the first thing is, obviously, we're talking about the legal and financial closing requirements, right? What are the things that the buyer is going to require you do before they sign, before they sign the deal?
Yeah, and oftentimes in this, where I find this is the challenge, is defining what the terms are in the agreement. And it may sound like inside baseball, but defining, especially the earnout terms, like what specifically you're being paid and what's being measured, what's being managed, and what you're being paid on is really important. What they're buying, are they buying assets, are they buying the whole company? Those types of things are really important when you're before you sign this agreement. You have to make sure what you're transferring. Is there any IP that's not transferring? Is there anything that's licensing? So these are really important steps that at this point you've already gone through due diligence. Sometimes people gloss over this and skip this. It's why you need to have a really good attorney and a really good M&A advisor, because they're tasked, Joe and I are tasked with doing these things and making sure that all the owners understand what is part of the sale, all the components of it. And we like to map it out in a separate document and say, this is what's being sold. Do you understand that this is being sold?
And do you understand that this is what you're going to be responsible for in the earnout period, right? Understand that you may be brought on as you may even retain the CEO title. You might be president of a division moving forward for 3 years minimum. You will have a contract, with this new company that says this is what you're going to do. And in order for you to collect all of the money you've been promised in the sale, you're going to have to hit certain milestones. We want to make sure from the beginning, before you sign the deal, certainly before the deal closes, that you understand and that everybody's on the same page about what those metrics are, and that we all feel comfortable with the fact that you're going to be able to hit them. Same thing is true.
You can control them. Sorry, just to add one more point to that is the last thing you want to do is sign something where, okay, great, you totally understand the 3 things you're going to be measured on, but you can't control any of them in the end state. That's a real problem.
That's exactly right. Total red flag. And also from an integration standpoint, again, this is where this comes back. What are your expectations around the handover and around the integration? What redundancy do we expect to have between in terms of employees and things like that? Are you going to have to let people go, or have you made a requirement of the deal that you hold on to or has the buyer made a requirement of the deal that they hold on to certain employees or things like that? And if those employees leave or things like that, that can really hurt you. in terms of the integrations, things like that. Also, it's a cultural thing. And I think what a lot of people do is that they see the money, John, right? And they see how much money they're going to make and the whole thing. And they're like, well, whatever, it's fine because I get this money. But as we said before, right, there's about 60% of all sellers will report the fact that after the deal closed and while they're even in the earnout period, that they didn't really like the way that the company was being integrated. I had a personal experience with that when I sold my digital marketing company, where the integration over the next 3 years was just kind of like a race to the bottom. It just everything just kind of fell apart in terms of what was great, what we thought was great about our brand and our culture was just eroded away by a bigger fish that had a different culture that was more dominant, right? So ensure that your deal includes specific and documented integration process and exactly what those earnout metrics are. And as John said, make sure, damn sure, that those metrics are something that you can actually have an effect on before you sign it, before you go forward with the deal. So those are the basic processes. As you can see, we are in a situation where this is not a 6-month deal. Okay, right, John? I mean, this is not, generally speaking, this is not the kind of thing that's going to happen as quickly as most people want it to happen.
Yeah, I mean, again, it's like the fast, cheap, and good, right? You don't want to sell something fast because you're not going to get a good price for it. So what you really want to do is make sure you start these things early so that you can understand sort of what the length of time it takes to, I mean, think about it. If you have 100 customers and 40 of them are one company, how long is that going to take you to reduce that 40 to 30? It's just math. It's going to be, you're going to have to sign up a number of customers to reduce that if you don't lose any of those, right? Lose any of those 40. So those types of things are, not overnight things. Sure, you can bring in that forensic accountant to clean up your books in a relatively short order in most cases. And you should do that, but realize that some of these things are fundamental things that will take a lot of effort from not only you, but also outside people in your team to get right.
No question about it. So let's talk about 12. There are 12 things right now that we see in general. Okay. And this is for any company, not just SaaS companies, but it does apply here in terms of a process that we've developed that will help you be able to kind of walk through and get through that big process that we showed you. And it's basically these kind of 12 things that we want to start taking a look at. So the first thing is that, and this is so important, right, is to develop an exit mindset. As the founder of the company, you need to change the way that you're thinking. Right?
Yeah, you change your orientation, right? You're no longer selling your product or service, you're selling your company. Full stop. If you have that mindset and you act accordingly, then your activities at the company will by definition change, right? Again, you're no longer going on every sales call. Not every sales call, any sales call really. They're not relying on you to do the day-to-day operations of the company and sell or do the finances or do the operations. Your mindset is on selling your company and doing all the things we've talked about early in this webinar to get that outcome and just to plan. And a lot of it is you're getting other people to do work, but you have to do the specific work too to set that up and to put people in motion, put things in motion as the person sort of floating above the business.
That's right. And in SaaS companies, what we often find too is that the founder is a technical person, right?
Yes.
And so you're an engineer, right? And you've developed and written the software or whatever. And now you're telling me that, and maybe you've had some business help, or maybe you've done a lot of it yourself or whatever, and you've gotten to this point. And if you don't change the way you or aren't capable, this happens too, of changing into this kind of other business mindset, that's where you really want to be able to make sure that you're bringing in some outside help and that you're building an exit team, right? So it's not just about changing your mind. It's about realizing that maybe this is not my strong suit, and I better bring in some maybe get some internal people and some external people together and build this team, moving forward, so that I can make sure that I can maximize this exit. Assessing your total exit value score. We haven't talked about that much today, but understand that if you take this assessment at assessment.myexitengine.com and you go there today, it's going to take you 2 minutes. All right. And what you're going to get as a result is you're going to get this total exit value score. This score is generally going to be low. Okay. And that's okay. What this score represents essentially is your propensity to be able to sell. And what you're using as a score is a single metric that's going to get you the ability to be able to monitor this over time as you increase the value and know that you're getting into a place where you are going to have a higher likelihood of being able to sell. So that's a very important thing, whether you do that with our tool or with anybody else's. Make sure that you are assessing yourself first. Change your mindset, get the team, start assessing what is actually happening with your business, and you have a really, really good idea of all the points that we talked about before. And then, of course, on your exit goals. Yeah.
Yeah, the exit goals are really important. Again, we're not going to go through all these, but this one's particularly important because, again, it sets up everything after the fact, right? It says, okay, if you define your exit goals in one way and there's 4 of them, well, then you're going to, when you're putting your team together and you're putting your plan together to do these things, those are going to be part that's the main component of it, right? It's what's important to you. If you want to position at the new company, you want to stay there for 3 years, you want an earnout, you want X, Y, and Z. Those are defined in your exit goals. We've talked about optimizing financials and de-risking your business, right? Those are the churn metrics, diversifying your revenue. The 7th one, build a strong leadership team and succession plan. Super important, right? What often happens when you're selling your company is, oh, it's the John show or the Joe show. No. When a buyer is buying your company, they want to buy the company. They're not going to be buying you or me or John. They're going to be buying the business and the underlying fundamentals of the business and the team that's going to remain after you exit and go to Cabo or start working on your new venture. So it's so important to test and to build your leadership team and have succession plans, not just for the top people, but for the people throughout the organization who you've tapped and deemed to be potential leaders at the company. The buyers will appreciate that because they're going to have to do it when they buy, after they buy the company. If you provide them with an org chart and color around who are the potential leaders at the company, yeah, they might disagree with you, but at least they have a starting point.
And the other thing that's really, really important on this list too is because we've talked about some of the other things, but the most important thing here is number 10, okay, which is to say, now that you've gotten this place and you know that you're going to get a windfall of money and somehow, now you really got to make sure that you're talking to a wealth planner, right, and an accountant who's going to help you optimize the sale for taxes and a wealth planning strategy, okay. We see so many people who have get all this money and stuff, and then suddenly the capital gains, comes in, and they're like, "Oh my God, I thought I was going to get this much money, and now I'm only getting this much." And of course, when you're getting an earnout situation, that can have an effect on that stuff as well. So we highly recommend that part of your team is you've got a tax person and a wealth planning person that's going to help you kind of manage this stuff, moving forward. Right.
Totally agree.
So we've done a lot of information here. I'm sure that it feels a little bit like we're drinking out of a fire hose, and we apologize for that. But the reality is that, John and I are on a mission to help 1,000 founders like you guys be able to actually successfully transition and maximize their exit value over the next 6 years. It's very important that we get this information out to as many people as we can. So even if you guys are not yet ready for this, if there are people that please share this with them. This is the kind of thing that we have to. What we see in general in mid-market M&A right now is that there are not enough companies to buy, and the reason there aren't enough companies to buy is because most of the founders don't have this information. They don't know what they don't know about selling their company. So here's some things that we can do right now in terms of where we can go from here. Okay, so after this call, we implore you, okay, take our assessment. It's free. There is no obligation, okay? But go to assessment.myexitengine.com and get your free total exit value report for your business, all right? Take a look at it. We'll understand it. If you'd like, we can schedule a conversation about it, just take you through so you understand what are the things that I have to do right now based personally for me, for my business that are, and it's not the same as the next guy. What can I do for my business that's going to help increase my total exit value and my saleability, right? Another thing is, if you are a little bit further away, then the Exit Engine podcast is a place for you to start. That's podcast.myexitengine.com. And we that episode we have a new episode that comes out every single Friday, and we take where we take basically everybody kind of through all about exit planning, all the trials, the tribulations, the pitfalls, the things to look out for, and we give you all that. And it's completely free. All right. Also, find us on LinkedIn. You can find Exit Engine Community on LinkedIn. You can find Exio on LinkedIn if you like as well. And both John and I are there. Our names right there on the screen. Joe Stapleton, that's J-O. So it's be LinkedIn.com, at LinkedIn and at Joe Stapleton and at John Caniffe. Again, it's 2 N's and 2 F's, for John Caniffe there. So follow us there because we are doing this stuff all the time. All right. Every day, every week, we post 5, 6, 7 things that are tips and tricks and lists and things for you to be able to take advantage of that are completely free. All right. This is so important that we understand that there are people out there leaving so much money on the table right now, or worse, not being able to sell their businesses at all because they just don't understand the basic things they need to be able to be aware of in order to make sure that they can make the best high value exit that they can. So we only got a few minutes left. Oh, sorry, John. Do you want to say them? Yeah.
I was going to go to a question because it came up. Actually, 2 different people asked it. And it's a simple question, but it's where do I start?
Mm-hmm. Right. It's a great question. So again, I think let's go back to the very first thing is to start learning what you don't know about your own business. Okay. Oftentimes we get so caught up. You might be getting financial reports from your accountant. I'm sure that you were keeping on top of your annual and monthly recurring revenue, and you're getting some basic, profitability reports and things like that, right? Hopefully you have a pretty good handle right now on where your business lies, but we also can tell you from experience that most people, again, are missing some things by not looking in the right places. Okay. John mentioned some really easy ones early on, right? Being able to make sure you're correctly characterizing expenses and revenue and making sure that you're attributing the right money to the right customers, being able to look at all this stuff, because this is the kind of stuff that will be uncovered in due diligence. Okay. So understanding if you can get there first, it's like any kind of lawyer will tell you, right? That what they want to do is they want to make sure that they know the answer to every possible question before it's asked. Okay. So the best, very, very, very best place to start with that today is to go to assessment.myexitengine.com. Take 2 minutes out of your life, right? That could result in you making sure that you're not leaving, money on the table. I think that if anybody would like to have this presentation, we'd be happy to send it to you. Just drop your email address in the chat. And let me know, just say presentation with your email address, and we will make sure that you get a copy of this so that you can take it and have it, and you can follow it and use it. And if we just did that today, then I would be very happy to make sure that as many of you were able to at least start this process. Our time is running up. I want to say thank you so much to my partner, John. Couldn't do this without you, buddy. Thank you so much. I want to shout out to Dave. To Dave Summers, actually, who helps us put these things together, and to all of you, I will say, one final time is the best things that you can do for yourself is to start examining this stuff and changing your mindset from the guy who was coding stuff into the guy who's now selling a business, guy or gal. Okay, and we want you to know that this is not as simple as you might like it to be, but with the right help from us or from somebody else, we can guide you through the process and make sure that you are able to maximize your value and saleability and get the best exit that you possibly can. Thanks again for your time. Appreciate it. Drop something in the chat. We're happy to send you this email. Check us out at myexitengine.com, podcast.myexitengine.com, assessment.myexitengine.com. See how easy we kept that? Really cool, right?
Love
Excellent. Thanks so much. Have a great day, guys. Appreciate it. We'll see you next time.